Welcome to our session on reading the market story. The goal today is to move beyond simple pattern memorization. To gain a professional edge, we need to interpret the underlying psychology driving price action. As the visual suggests, a candlestick pattern is only as powerful as the context surrounding it. The true skill isn't just identifying a shape on a chart, but understanding exactly where and why it appears. To help you master this, we've developed a complete strategic framework. First, we'll look at the toolkit, identifying the essential building blocks of price action. Next, we'll establish the rulebook, providing the logic and principles needed to filter signals. And finally, we'll dive into the action plan, which gives you a step-by-step approach to executing trades with confidence. Let's get started. Now, let's break down the anatomy of a single candlestick. Understanding these visuals is essential because they represent the battleground between buyers and sellers over a specific period. Every candle is defined by 4 key price points: the open, high, low, and close. The color of the candle indicates the direction. Green means the price closed higher than it opened, while red means it closed lower. The center part is called the real body. This represents the primary price action. The size of the body tells us about momentum. A larger body indicates a much stronger move. The thin lines extending from the top and bottom are the wicks, or shadows. These show us the price extremes of the session. Long wicks are particularly important because they reveal pressure. They show where prices were rejected, signaling that one side pushed back against the other. By combining these elements, we can determine the overall market sentiment. It allows us to see who ultimately won the session, the buyers or the sellers, and helps us anticipate what might happen next. Next, we have the engulfing pattern, which represents one of the most decisive shifts in market momentum. This pattern is categorized as having very high reliability because it clearly shows one side of the market completely overwhelming the other. On the left, we see the bullish engulfing pattern. This typically occurs at the end of a downtrend. A small red candle is followed by a much larger green candle that completely engulfs the previous day's price action. Psychologically, this tells us that while bears were in control, bulls have stepped in with a powerful surge, signaling a clear reversal to the upside. Conversely, on the right is the bearish engulfing pattern. This appears during an uptrend when a small green candle is swallowed by a large red candle. This indicates that the bull's momentum has stalled and bears have taken over with a significant sell-off. In both cases, the size of the second candle is key. The more it dwarfs the first, the stronger the signal that a new trend is beginning. Now let's look at 2 of our most powerful rejection signals, the hammer and the shooting star. Starting on the left, the hammer is a bullish reversal pattern. You'll recognize it by its small body at the top and a long lower wick, ideally 2 to 3 times the size of the body itself. From a psychological standpoint, this tells us that although sellers pushed prices down, buyers stepped in with enough force to reject those lows and close the session near the high. This signal is highly reliable, especially when it forms at a key level of support. Conversely, on the right, we have the shooting star. This is the bearish equivalent, typically appearing after an upward move. It features a small body at the bottom and a long upper wick, showing that buyers were unable to hold on to higher price levels. Sellers effectively rejected the highs, forcing the session to close near its low. This indicates a strong shift in momentum, and like the hammer, is most reliable when it occurs at a clear level of resistance. Next, let's look at 2 of the most reliable reversal signals in our toolkit, the morning and evening star. These are 3 candle patterns that signify exhaustion and a subsequent shift in market momentum. On the left, the morning star appears at the end of a downtrend. It begins with a long red candle, followed by a small-bodied candle, like a doji or spinning top, representing indecision. The pattern is confirmed when a long green candle closes above the midpoint of that first red candle. Psychologically, this tells us the selling pressure has dried up and buyers have stepped in to take decisive control. The evening star, on the right, is the bearish mirror image. After a strong uptrend, we see a long green candle, a small middle candle showing hesitation, and finally a long red candle closing well into the body of the first. This indicates that the bulls are exhausted and the bears have successfully reversed the trend. Because both patterns represent a clear transition from indecision to a new direction, they carry a very high reliability rating for identifying major trend reversals. Now, let's look at how to interpret market indecision by focusing on two key candlestick patterns, the doji and the spinning top. Starting with the doji, you'll recognize this by its distinct cross or plus shape. This occurs when the open and close prices are at or very near the same level, representing a perfect balance between buyers and sellers. Psychologically, it signals a moment of pure indecision and serves as a potential warning of an upcoming trend change, especially if it appears after a strong price move or at a key support or resistance level. The most important takeaway here is that a doji is not a trade signal on its own. Its significance is entirely dependent on its location within the broader chart. Next, we have the spinning top. This candle features a small body with long upper and lower wicks of similar length. While it looks different from a doji, the message is similar. It represents significant volatility during this session, but resulted in no net change. It shows that neither the bulls nor the bears could gain control, suggesting a potential pause or reversal. In terms of reliability, a spinning top is weak in isolation, but it becomes a much more reliable indicator when it forms part of a larger multi-candle pattern. Next in our toolkit, we're looking at continuation patterns. These are vital signals for confirming that the prevailing market force is still in control and the current trend is likely to persist. Starting with bullish continuation, we first have the three white soldiers. This pattern consists of three consecutive long green candles closing progressively higher, signaling strong and steady buying pressure. Below that is the rising three methods. Here, a strong upward move is followed by a brief, healthy consolidation, represented by three small red candles, before the uptrend resumes with another large green candle. Turning to bearish continuation, we see the three black crows. These three consecutive long red candles signal dominant selling pressure as the market pushes lower. Finally, we have the falling three methods. This pattern starts with a sharp drop, followed by a weak rally of three small green candles that ultimately fails to break the trend, before the price falls again with another strong red candle. Recognizing these patterns helps traders stay aligned with the trend and trade with greater confidence. Now we arrive at the golden rule of technical analysis. Context is everything. While identifying a pattern is the first step, where it appears on the chart determines its actual value. Think of it as location, location, location. A pattern's reliability increases exponentially when it aligns with key technical levels. If you look at the green circle, we have a clear bullish signal forming right at a key support level. Because price has historically reversed here, this becomes a high probability setup. In contrast, look at the yellow circle. This might look like a valid pattern in isolation, but because it's floating in the middle of a move without structural support, it is a low probability signal. We must also consider the broader trend. Reversal patterns are far more likely to fail when they fight against a strong, established market direction. Ultimately, remember this: a perfect pattern in the wrong place is a trap. Always look for the where before you trade the what. Moving on to one of the most critical principles in technical analysis, the principle of confirmation. It's often said that a candlestick pattern is a question, not an answer. The pattern suggests a potential move, but the next candle provides the confirmation you need before committing capital. To trade with higher probability, we focus on three key pillars. First, subsequent price action. Instead of jumping the gun, wait for the following candle to validate the signal. For a bullish reversal, we want to see the next candle close higher. This proves that the momentum has actually shifted. Second, we use volume analysis. A price move is only as strong as the volume behind it. We look for a significant surge in volume on that confirmation candle, which signals high conviction and institutional participation rather than just market noise. Finally, we look for indicator confluence. Never trade a pattern in isolation. Check if the signal aligns with other technical tools, such as a key moving average, an RSI divergence, or a Fibonacci retracement level. By waiting for these secondary signals to align, we move away from guessing and toward a disciplined, high-probability strategy. Patterns are important, but they are not infallible. Even the highest probability setups can fail, which is why professional success is defined by how you manage your losses, not just your win rate. To stay disciplined, we follow 3 non-negotiable rules. First, always define your stop loss before you enter. This is your clear invalidation point, the level where the trade idea is no longer valid. Second, calculate your position size based on that stop loss distance. A professional never risks more than 1 to 2% of their total account on a single trade. Finally, demand a favorable risk-to-reward ratio. As shown in the diagram, we look for a minimum of 1 to 2. By ensuring your potential profit is at least twice your potential risk, you allow the math of the market to work in your favor over the long term. To achieve mastery in trading, we have to bridge the gap between amateur habits and professional execution. This starts with identifying common pitfalls and applying disciplined solutions. First, avoid the trap of trading every pattern you see. Professionals filter relentlessly, focusing only on high-probability A-plus setups that occur at key levels. Remember, a pattern is only as good as its context. Always prioritize the pattern's location, such as major support, resistance, or the broader trend, above the formation itself. Timing is equally important. Stop entering trades immediately out of FOMO. Instead, practice patience and wait for the next candle or price action to provide confirmation and validate the signal. You must also ensure the time frame you are analyzing aligns with your specific trading style. For instance, using daily patterns for swing trades rather than getting lost in intraday noise. Finally, never force a pattern that isn't there. If a setup isn't obvious and clean, it isn't a trade. Protecting your capital for the most transparent opportunities is the most effective way to ensure long-term success. To achieve true mastery in trading, you need a consistent daily routine that builds your pattern recognition skills. It starts with a daily chart review at the end of each session, where you actively mark up and label every candlestick pattern that formed. Don't just spot the patterns, analyze the outcome. Note which ones followed through and which ones failed. Crucially, you must identify the context. Was the pattern at a key support or resistance level? Was it aligned with the trend? Was there volume confirmation? By documenting these details, you will build a personalized playbook of high-probability setups that work best for your market. If you're wondering where to begin, focus your initial efforts on these 4 priority signals: engulfing patterns, hammers and shooting stars, morning and evening stars, and dojis appearing at key levels. Mastering these 4 first will provide the solid foundation you need for long-term success. To wrap up, let's review the Candlestick Mastery Framework through 3 core pillars: the toolkit, the rulebook, and your action plan. First, your toolkit is about identifying the what. Focus your initial energy on mastering high-priority patterns like engulfing bars, hammers, and morning or evening stars. Treat dojis as critical warning signs at key levels and utilize continuation patterns to ensure you are trading with the prevailing trend. Next, the rulebook defines how we actually trade. Always remember that context is everything. A pattern's location on the chart determines its validity. Confirmation is mandatory. Never trade a pattern in isolation without validation from price action or volume. Most importantly, manage your risk religiously by using predefined stops and maintaining a favorable risk-to-reward ratio. Finally, we achieve mastery through a dedicated action plan. Shorten your learning curve by actively studying common traps and mistakes. To build elite pattern recognition skills, you must practice with purpose through a consistent daily routine. Following this framework will move you from simply recognizing shapes to truly understanding market sentiment. Now that you've mastered the basics of candlesticks, it's time to build a true analytical edge. To transition from understanding patterns to executing profitable trades, we recommend focusing on these 3 core disciplines. First is risk management. This is the ultimate shield for your portfolio. While amateurs often focus solely on potential gains, professionals prioritize protecting their capital. Mastering these strategies ensures you stay in the game by keeping your losses small while you work to maximize your winning trades. Next, we dive into market psychology. Every candlestick pattern is a reflection of human emotion, specifically the tug-of-war between fear and greed. By understanding these sentiment cycles, you can better interpret the why behind price action and anticipate market shifts before they fully materialize. Finally, we need to broaden your technical analysis toolkit. Candlestick analysis is powerful, but it is most effective when integrated with broader chart patterns, trend identification, and key technical indicators. Combining these elements provides a much more holistic view of market behavior. By integrating these three pillars with your knowledge of candlesticks, you will move from basic observation to a professional, disciplined trading strategy. This guide provides a quick reference for the most common candlestick reversal patterns used in technical analysis. We've categorized them into bullish patterns, which signal a potential move to the upside after a downtrend, and bearish patterns, which suggest a possible downturn following an uptrend. On the left, you'll see key bullish signals. Patterns like the bullish engulfing and the morning star carry a very high reliability rating because they represent a decisive shift in control from sellers to buyers. The hammer and piercing line also offers strong indications that lower prices are being rejected. On the right, we have the bearish counterparts. The shooting star and bearish engulfing are particularly significant as they show bears overwhelming buyers at the top of a trend. Note that patterns like the inverted hammer and hanging man are marked as medium reliability, meaning they typically require extra confirmation from the following candles before a trade is considered. Most importantly, remember the note at the bottom. These patterns are not signals in isolation. To trade them effectively, you must always consider the broader market context, wait for proper confirmation, and maintain strict risk management.